topic is methods of capital account. Content: capital account introduction, methods of capital account, fixed capital account, fluctuating capital account, format of fixed and fluctuating capital account, problems in fixed and fluctuating capital account. Finance is the lifeblood of the business. For starting and running the business in the firm, partners invest either cash or kind or both to the firm. That contribution is called capital. Whenever a partner contributes capital, cash or kind, that account is debited and a separate capital account is opened for each partner and their contribution is credited. Methods of capital account. There are two methods to prepare capital account. First one is fixed capital method. Another second one is fluctuating capital method. The firm can follow either the fixed capital method or the fluctuating capital method. First, let's see fixed capital method. Under this method, the initial capital contributed by the partners remains unchanged throughout the lifetime of the business. If a partner introduces any additional capital or if he withdrew capital, then this account is influenced. If he introduced a huge amount of additional capital or if he withdrew capital permanently, then this account will be changed. Otherwise, under the fixed capital method, capital account of the partner is not changed, it is static. Under this method, two accounts have to be opened to each partner. They are partner's capital account and partner's current account. Under the fixed capital method, first we have to prepare partner's capital account. This account is credited with the original amount of capital introduced by the partner into the business. If your partner introduced extra capital or if he withdrew money permanently, this account is credited or debited respectively. No other adjustments are made in this account. And the balance of capital account remains fixed. That is why this method is called fixed capital method. The capital of the partner is remained unchanged, static, and so this method is called fixed capital system. The second account which should be opened under the fixed capital method is partner's current account. This account is maintained for making all entries relating to interest on partner's capital, drawings and loan, share of profit, partner's salary and commission. The balance of current account is fluctuating. See, under the fixed capital method, capital account is static and current account is fluctuating. If the firm follows a fluctuating capital method, only one account is required. That is the capital account, and that capital account is influenced by every transaction between the firm and the partners. All the transactions are entered into this capital account. We don't need to open two accounts. Only one account, that is essential. All adjustment in respect of drawings, interest on capital, interest on drawings, salary or commission to partners, share of profit or loss, etc. are made directly in the capital account. That is why the capital account is changed. It is not a static one. That is why it is called fluctuating capital method. As I told, naturally the capital balance at the beginning of the accounting person is affected and therefore it is different at the end. The balance in capital account goes on fluctuating from time to time and is not a fixed one. That is why this method is called fluctuating capital method. In the beginning, the capital may be 1 lakh. At the end, it may be 2 lakhs or 1,80,000 or 2,50,000. It is changed because all the adjustments are made in this capital account. This is the format of fluctuating capital method, capital account. Okay, partners capital account is usually prepared from the viewpoint of the partners. All the expenses of the partners should be debited and all the income of the partner should be credited. This is the opening capital, that is the initial capital contributed by the partners, that should be credited. Then interest on capital is an income, so it should be credited. Commission to the partner is a income for the partner, that also should be credited. Share of profit, salary and all income to the partners, and so these items should be credited. Drawing is an expense, interest on drawing is an expenses for the partners and so it should be debited. So finally we arrive the closing capital. Okay. So this is the way to prepare partners capital account under the fluctuating capital method. This is the format of partner's capital account under the fixed capital method. This is the opening capital. All the adjustments are made only in the current account. So it is static. So this is the opening capital and this is the closing capital. This is the opening capital of the next accounting period. In this way, we have to prepare the capital account under the fixed capital method. See, under the fixed capital method, we have to open two accounts. One is capital account, another one is current account. This is the format for the current account. This is the initial amount, then by interest on capital, by commission, by salary, by share of profit, and this is the drawings, interest on drawings, and to balance. This is the current account balance, opening balance. This is the current account closing balance. Okay, all the adjustments are made in the current account. Interest on capital, it is an income and so it should be credited. Commission, salary, share of profit and all income to the partners, so that should come under the credit side. Drawings and interest on drawing is an expenses to the partner and so it should be debited. So finally we get the closing balance of current account, and that would be the opening balance of the next accounting year. In this way, we have to prepare the current account. So this is question number 1. The firm is following fluctuating capital method. How we have to prepare capital account? Let's see. A and B started a partnership account on 1st January 2018. They contributed 80,000 and 60,000 respectively as their capital. The terms of partnership agreement are as follows. Interest on capital and drawing 12% per annum. A and B get a monthly salary of rupees 2,000 and rupees 3,000 respectively. Then the sharing of profit and loss will be in the ratio of their capital contribution. The profit for the year ended 31st December 2018 before making above appropriation was rupees 1,300,000. The drawings of A and B were rupees 40,000 and rupees 50,000 respectively. Interest on drawing amounted to rupees 2,000 to A and 2,500 for B. Prepare P&L appropriation account and partners capital account assuming that their capital are fluctuating. The information given in the above problem is a salary. A's monthly salary is 2,000. It should be converted into yearly. 2,000 into 12, 24,000. B's monthly salary is 3,000. So yearly salary is 36,000. Interest on capital 80,000. A contributed. B contributed 60,000. 80,000. The rate of interest is 12%. 9,600. The rate of interest is 12%. 60,000. So 7,200. Interest on drawing directly given in the problem, that is 2,000 and 2,500. Profit sharing ratio is capital contribution. Capital contribution is 80,000 and 60,000. So the profit sharing ratio is 8:6 or 4:3. First we have to prepare P&L appropriation account. Interest on capital already we have calculated. A 9,600, B 7,200. So P&L appropriation account should be prepared from the viewpoint of the firm. For a firm, interest on capital and salary is an expense. So that should be debited. 9,600 plus 7,200 is 16,800. Salary for A is yearly salary is 24,000. B is 36,000. So total is 60,000. Net profit before adjustment is 1,300,000, and then interest on drawing that is given directly 2,000 and 2,500, that is 4,500. If from 1,04,800, if we deduct the 76,800, we will get 28,000. That 28,000 should be distributed among the partners in their profit sharing ratio, that is 4/7 and 3/7. 4:3. 4/7 into 28,000 is 16,000. 3/7 into 28,000 is 12,000. In this way, we have to prepare P&L appropriation. This is the capital account of the partners under the fluctuating capital method. This is the opening capital 80,000 and 60,000. Then from that, that should be credited, and drawing, interest on drawing should be debited because it is an expense, and so it should be deducted. It reduces the capital account of the partners, and so it should be debited. Salary, interest on capital, P&L appropriation is an share of profit and loss account is an income for the partner, and so that should be credited. So by balance brought down is 80,000 and 60,000. Drawing is 40,000, 50,000. Interest on drawing is 2,000 and 2,500. Salary is 24,000 and 36,000. P&L appropriation is 16,000, 12,000. The total of credit side is 1,29,600, 1,15,600. Sorry, 200. So the balance is 87,600. This is the closing capital, 62,700. So that would be the opening capital for the next accounting year, that is 80. So the next accounting year balance, opening balance is 87,600 and 62,700. One more question, let's see, under the fixed capital method. On January 1st, 2015, Kala and Mala entered into partnership and contributed rupees 20,000 and 15,000 respectively. They share profit and losses in the ratio of 3:2. Mala is to be allowed a salary of 4,000 per year. Interest on capital and drawing is 5% per annum. During the year, Kala withdrew rupees 3,000 and Mala rupees 6,000. Interest on drawing being Kala 70, Mala rupees 50. Profit in 2015 before the noted adjustment was rupees 10,580. Prepare P&L appropriation account and capital account assuming that the capital accounts are fixed. Given information under the question number 2 is partner name Kala and Mala. P&L ratio is 3:2. Capital contribution is 20,000, 15,000. Salary is 4,000 per month to Kala, and drawing is 3,000 Kala and 6,000 Mala. Interest on drawing that is given 70 rupees, 50 rupees. Interest on capital and drawing is 5%. Profit before adjustment is 10,580. These are the information that is given in the problem. First, let's prepare the P&L appropriation account. By net profit brought down before adjustment is 10,580. Then salary to Mala is 4,000 per annum, so that should be debited because it is an expense for the P&L firm. Then interest on capital is Kala's contribution is 20,000. 20,000 into 5% is 1,000. Mala's contribution is 15,000. 15,000 into 5% is 750. So the total interest on capital is 1,750. Interest on drawing that is directly given, Kala 70 rupees, Mala 50 rupees, 120. So the total of the credit side is 10,700. So from that 10,700, if we deduct 4,000 plus 1,750, that is 5,750. We have to deduct, we will get the balance is divisible profit is 4,950. So 10,700 minus 5,750 is 4,970. 950, sorry. That should be shared between the Kala and Mala in the ratio of 3:2. So 4,950 into 3 by 5 is 2,970, and Mala's is 4,950 into 2 by 5, that is equal to 1,980. In this way, we have to prepare the P&L appropriation account. So that form follows the fixed capital method. So we have to open two accounts. One is partner's capital account, another one is partner's current account. So under the partner's capital account, the opening balance of Kala and Mala is 20,000 and 15,000. No other adjustment should be made in this account. So the closing balance also the 20,000 and 50,000. Next year opening balance is also 20,000, 15,000. It won't be changed. It remains a constant and static. That is why it is called fixed capital method. Then we have to prepare the current account. Under the current account, we have to make all the changes. Salary 4,000 Mala. Interest on capital 1,750. Already we have calculated. Then P&L account, profit share is 2,970 for Kala, 1,980 for Mala. Then drawing is 3,000 Kala. Mala is 6,000. Interest on drawing is 70, 50. So the total of the credit side of Kala is 9. The total of the balance of the total of the credit side of the Kala is 3,970 and Mala is 6,730. So the balance is 900 and 680. So the next year balance of the current account is Kala is 900, Mala is 680. With this, the methods of capital account is over. In the next class, we will see the guarantee and past assessments. Thank you.